All right. Welcome back, friends. It's our first week back in 2026, or the first full week back. And this week, our trades returned anywhere between 9.5 and $14,000, depending on how many or which of the systematic trades you combined, along with our discretionary trades. Probably the key thing this week that we benefited from was the fact that we did have a nice bullish market, so it did allow some of our trades to kind of hold up really well after having a digestive November and December. So a big part of our system is that we trade both the systematic and the discretionary trades, and our systematic trades continue to give us those compounding, scaling returns where we know what the overall win rate is and where we can kind of base our overall system on. But then on the flip side, we do like to play discretionary trades where we see really strong breakouts and really strong potential moves, or we see consolidation and digestion. One of the key things probably that really rewarded us some really great returns, and you can see it down here on our Datadog trades, our crowd trades, our AVGO trades, is that actually towards the end of the year, we really had strong breakout moves on those underlyings, but our positions were looking at gamma, we're really looking at strike prices that were below where the price had jumped up to. So our expectation was after that really big push that we would start to see a pullback and see some digestion back into the normal range. And that's where our calendar and diagonal spreads would start to really expand in value. So this week we were really able, you can see, to take some significant profits off the table off of a lot of our diagonal trades, which we did open. Oh, these are the close, sorry. We did open up back in September, October, and even early November. So those were some really great trades that we had going for us. Let's just see. Actually, let's open up Datadog because that's a great way to kind of share what it is that we are looking at here. Oops. So um, as that's pulling up, we can also look at AVGO. It's a similar thing. So we were really looking for a push. We were expecting, as you can see, this push up into the 400 area, but then we had for December AVGO back at the 350. So a lot of our trades were positioned around this 380, 390 area, expecting that we would get a run up, but you see that we hit that 400 area 3 months earlier than our expectation. But since the gamma for December and early January was still centered around this 340, 350, 360 area, we were expecting a strong pullback. So our trades likely would, I mean, our trades didn't return that much. When we had this really strong pullback, we were up maybe only about $1,200 on each individual calendar or diagonal. But then with the pullback, you saw that those started to significantly pop up to the $2,000 and $3,000 return. And then the percentage gains on that you can see are well over 100%. Now, the reality is that we've had these positions on since October, and we have been rolling out those short calls. So the return of 100% and 200% is really on the last part of that trade. But we have been collecting credit over the duration of the time. And you can see that because of the fact that this has closed. So it's not showing all of the data, sadly. But it does allow you to see that, we did enter this trade and then we were able to close at least for the 120. But as I said before, because we had been rolling out those shorts, we mitigated entirely our entry price and we were able to take in consistent credit against the position while it was moving up. Um, so some of the trades that we took were also on Rocket Lab. We were expecting this breakout move, and we're expecting a continuation in the breakout move. Even though this may seem very overextended, it is natural that we may get a pullback into the zone below us. So we couldn't very easily get a pullback to the 75. but we continue to be really bullish on Rocket Lab, especially with the amount of money that Trump is pouring into defensive spending. Umbrella is a battery company. This is a company that we have wanted, that we've continued to be in. We've been playing this since down at the 40 and then been riding it up with two different types of trades. We have consistently partnered long call butterflies with our short straddles, and we're utilizing the short straddles to be able to continue to obtain new shares of Umbrella with but utilizing the returns on those short straddles in order to bring in the extra cash. So let's just go up into our trade management update so we can look at this together. So as you see, we did have a long call butterfly on Umbrella. That did not perform this time around. As you can see from the chart, we had that really nice base, but then we did at the end of the year get a pullback without bullish activity in this week of January. So instead of waiting for that to kind of decay to nothing, we actually managed the trade. So we actually turned that long call butterfly into a call credit spread, and we were able to take in enough credit to mitigate about 40% of the cost of entry, and we can manage that trade again to take in another credit and again mitigate our cost of entry. AVGO, you can see here, we do still have a longer duration diagonal spread that's on that we did not close, but we did close this AVGO position at the 390, 370 and the 380, 370. And yeah, so those have returned, have done us very well in our accounts. So congratulations to those that took the trade. And then, we had a lot of trades on from 2026 that were expiring January 16th and in February. So we just decided to clean up shop a bit just because it was getting a little overwhelming with the number of positions we had on. Here you can see that we had this call calendar, and this demonstrates what I was talking about previously, where we did actually enter this trade for a debit. We did pay to enter this trade, but over time, because of the number of times we have consistently rolled out this short call, we've been in the trade since October. So through October, November, in December, and even in January, we've continued to roll out that 5-10 call. And each time we've been able to receive a very nice credit for those changes. So in fact, it looks like we received $1,700 to be in the trade, and that $1,700 is the amount of money we were receiving on those rolling out the short calls, while at the same time being able to profit from the long call. So overall, we were able to make more than $2,500. Congratulations to those that both entered the trade, but also continued to stay diligent to do the trade management position, so that you're not just making money off of one occurrence of a move, but that over time you continue to scalp profits off the position that you are in. Datadog was the same way, as you'll see in the chart. Datadog did the same thing as AVGO. It had a really strong spike up into about November and then just dumped down. We were not surprised by that. So we were able to take advantage of those moves. And here you can see that on our multiple calendar and diagonal spreads, we were able to return $115 or $2,000, $2,300, $2,500 return. So these are very low risk strategies, and they continue to be very profitable for us. So just to look at that Datadog chart, again, you can see exactly as I was saying that, when we kind of hit this high at 200, we were expecting a pullback to the 160, which was perfect for our position. But as you can see, it just continued to go down and dig deeper into this range. This is the bottom zone for this push up. So we do expect that Datadog could very easily sweep this entire area. It could even come back down to the 115. And because of that, it doesn't make sense for us to stay in any of our diagonal and calendar positions because our Datadog calendars are all the way up at the 165. So a drop to the 116 or 115, as you can see, we were starting to give back some of our returns. So it just didn't make sense for us to stay in while we saw such a healthy and positive return on our trades thus far. We can now take these profits and then roll them into more substantial positions that have more time on them to give us the bigger bang for our buck. Now, a company that we've continued to be trading on and has just done really well for us is Hut. That has just consistently all through 2025 has just hit all of its gamma targets to the upside or to the downside. We initially were playing a lot of call ratio spreads where we buy one call and then sell two calls further out the money. But for a lot of people, this can tie up a lot of margin. So it's not necessarily the best use of funds. So instead, we decided to transition that into long haul butterflies and more often than not, broken wing butterflies. And that has also been extremely successful because of the fact that Hut does have a tendency to pin to its monthly and quarterly OPEX levels. So again, then let's just look here. So we have a lot of long positions on Iran that did struggle a bit into the end of year. And so part of the way that we have mitigated the losses while we're waiting for this push to the upside, which we have time, as you can see, our March positions don't, our long positions don't expire until March, but we've consistently been selling put credit spreads behind the move up. So while you get these digestion moves, and we can look at the Iran chart, just so that we're all talking against the same thing. So here you can see Iran did have a really strong pullback, which we were expecting. We were expecting a rejection off of from inside this zone and a push down into the fractal and then a bounce back up. So we did get the moves that we were expecting, but we were expecting after this rounding that we might actually get a stronger push up before we had a fall down. So instead, we ended up with a lot of digestion. We see this pattern on a number of charts, a lot of charts, especially in the IWM, where you just, instead of the base being more consolidation for 2 or 3 weeks, that now it's been consolidation for 2 or 3 months. We are now beginning to see kind of a bounce out of that basing. But in order to not lose any of the value in those long calls or to mitigate the losses, so to say, then we added those put credit spreads. And we've been in those put credit spreads since the inception of the position. So we've always had the thesis that it would take Iran time to kind of move out of its range. So we have just reduced risk by adding those short downside positions, and that has served us very well. So congratulations to those again who not only took the position, but also continue to follow up on the trade management. A lot of times in Discord services, you will see, for those who are newer to the service, a lot of times what you'll have is just opening and closing, opening and closing, and opening and closing orders. And that's not what we do. We have opening orders where you see in daily calls, and then you will see the management. Now, we have so many positions on that it is natural that people don't necessarily see every single trade management, or they may not see it in time when it comes out. But if you do ask, then we do try to help you manage the trade as it is. So another company that has been kind of disappointing is HIMS. This is a company where a lot of people were expecting much more bullish activity because of the conversations around the Affordable Care Act and ongoing negotiations with Medicare relating to pharmaceuticals and so forth. But HIMS, like many of the other stocks, except for Eli Lilly and Merck and some of the ones that have that larger presence, those have done really well. Some of the smaller companies like HIMS and Oscar have struggled during this period. And we can look at that chart here really quickly. Oh, maybe I took it down. Okay. No big deal, because obviously this wasn't performing very well. But essentially what you have is a stock that's basically just grinding, and it has broken down out of its wedge, but is holding just below its wedge formation. So that's like really not very constructive. However, the fact that we utilized a short straddle, we don't really care if the stock moves. All we're trying to do is make money off of our existing shares. And that's what we did. We didn't make that much money, but considering that HIMS is just around $30, we did get um, a share and a half for free. Mostly we're using this to mitigate the downside action because the average entry price we have for our shares, depending on how you entered, is between $34 and $35. And currently HIMS is around $33. So the fact that we made $44 just means that we completely flattened any loss that we're experiencing on the share value. So we can sit in the shares longer without feeling like we are just letting our account bleed. We are forcing that stock to pay us for waiting for its performance. Then we did have a diagonal spread on HIMS. We do have all the way out till February and March. It was only down 30%, but I just found this trade to be very annoying and useless because I do not believe that HIMS is going to get up to that 60, 65 area anymore. If anything, it may get up to the 40. So we just removed this entirely and then added a new position that made more sense to the current bias of the trade. All right. So we'd already looked at HIMS. MP is another one. And this is a trade that your returns really depended on how you manage this trade. MP was very positive for us. But if you did not close the trade at that particular time, when the trade was up about 100%, if you waited for my call out of when I close this, then you did experience a loss. So it was an opportunity, and I suggested that if you wanted, you could manage this trade by removing the debit spread of the long call condor and keeping the call credit spread. But I chose not to do that. I felt like it was just going to tie up too much margin, and I can sustain a small loss in comparison to the fact that we have had major gains on all of our other trades. Sometimes you have to know when to stop managing trades, just because yes, you can get your money back, but if you just deployed the capital that you had made in other trades and focused on those, you'll end up making a much better return. And also, you want to really protect your mental health. You can trade and just trade so aggressively that because you're always trying to save every penny from here and penny from there, that you do overwhelm yourself and exhaust yourself mentally because you have too many trades on. It is one thing to be doing this for a really long time and have maybe like developed slowly some mental fortitude to have a thesis on 20 different stocks. But if that's not your disposition, then it's totally fine to have 4 or 5 trades on where you have a really high conviction and then you just manage those instead of trying to manage everything. And for me, I do realize when I come to a point where I feel like I'm managing too many things or I've been in a trade too long that I've kind of lost my sense of conviction on what it's going to do or where it's going to go. And though the trade is green and it could make more money, I don't want to make more money out of confusion. I want to be in trades where I have a really strong thesis that we are going to do A, we are going to do B. I think we are still moving towards B or we're still moving towards A. But I don't want to just look at a trade and be like, oh, this is making money, so I'm just going to stay here. And no, that doesn't make sense. So eventually you do have to, you do have to be honest with yourself when you're looking at a chart that you no longer have a conviction about where the positioning is of this underlying. You don't see how the time is going to decay from your position. You don't feel like you see your long positions gaining in value. And when you can no longer like speak those things into existence, it means you don't really have a conviction in your spirit about why you are in that trade. So, I mean, not to make it sound like this is a spiritual exercise, but it is a mental exercise. You should always know why you are doing what you are doing with your money. And that's the only way to do it, is to kind of sometimes verbalize it to yourself, especially if you've been in a trade for 2 or 3 or 4 months, right? So anyways, probably the biggest, most disappointing trade for me is our S&DK trades. Now, This is so disappointing because we got into this trade on December 8th and we just caught the entire move. Now, I don't, oh, here it is. So you can see here from the chart, December 8th is right here. So we entered this trade right here, and then we did get a little bit of a pullback, which was fine because we were in a call broken wing butterfly. But my expectation was that we would get to the 320 and then we would have a bit of digestion. Now, this is the daily chart. You see that we ran up to the 360. We did pull back to the 325, which was perfect for us. But then the very next day, we had another squeeze nearly up to the 380. So sadly, our position just couldn't cope with that. You can see that we're also in a broken wing butterfly, which actually means that we need a little bit more time decay on the overall trade for it to be able to perform. But right now we're above the entire broken wing butterfly. So the reality is that in a trade like this, we could sustain actually a greater than 100% loss. So we're at a 50% loss right now. It actually did, by the time we closed the trade, it did actually come a bit down because SNDK did have a little bit of a pullback in the afternoon of Friday. But this was a very disappointing trade just because the bullish activity, the buying action was really relentless, didn't really give us a good chance to get out of the trade. Now, I will grant it to the Discord members. There were many members who said, hey, SDNK seems to be doing a lot right now. We got to pull back on Thursday. Should we close out? And I said, I don't see gamma that high up. So I'm going to hold on to the trade. But a lot of other members, they decided to close out their trade and they actually got out for about 40%. So they made $200 on the trade, where I took a hit of about 180 in my actual account once everything was said and done with the actual buy to close. But it's very disappointing because this was a trade that could have returned us easily $3,000. So the fact that I didn't position this perfectly is disappointing. However, um, we were able to participate in the trade. For those that have smaller accounts, this did give them exposure to SDNK, even if, this trade didn't work out perfectly for us. And that's okay. Again, you can't have two, three, $4,000 wins without expecting to take a $1 and $200 haircut. That would just be unreasonable. And then LRCX was another one that was just way more bullish than we had anticipated. Again, a lot of people in the Discord were already seeing this. They closed out their trades earlier than me, but again, maybe I was being a little bit stubborn. I was expecting that we would get a little bit more of a pullback. I closed out this trade. Now, we have entered other trades on SDNK and LRCX. So it's not like this is the only trade we had on, but it is the one that we closed. And so that's that. Then for our systematic trades, for those who are newer, one of the big things is that with our systematic trades, we trade rules based. The returns on our trades were very good this week. Monday, Wednesday, Thursday, Friday, the trades closed without a hitch. Those hit $200-300 returns every single day. And then for some people who waited until the end of day, you were able to see $1,000-2,000 returns on those trades. Now, Tuesday, we did see a very strong bullish move. Based on the overall chart and what was happening politically, we were expecting the S&P to give us a nice pullback on the Wednesday. Now, I repeat, I do not normally manage iron condors or iron butterflies or credit spreads that have been breached by rolling out the trade. But it is a trade management technique when you have a strong thesis that on the next day you are going to get a pullback, that you can actually utilize that as a means of not only minimizing your loss, but potentially making more money. So this is, let's actually see. So that's the Thursday. Here is Also Thursday. Is this Wednesday? Yes. So as you can see on Wednesday, our trade was actually down here. And let me just open that up a little bit more for us so we can actually see what's going on and how it went all the way back to the Friday. My apologies. So on the Friday, we had a really nice position. On the Wednesday, sorry, we had a really nice move. Was that on the Wednesday? That yeah, sorry. I said on Tuesday. I meant to say Wednesday. Oh no, it was Tuesday. So Tuesday we had this push up and we ended up closing the day with a breach. So our call credit spread was completely in the money. And so I said that on Wednesday, I am expecting us to get a really strong, that we could get a really strong pullback, at least to the 69.30. Now, this is ES, not the S&P, so the numbers are a little bit different, but it's going to be irrelevant to the point, which is that so we decided to roll out that in the money call credit spread. One of the things is that when you have a credit spread that is in the money and you roll it out in the money, you get a very, very high credit. Now, a lot of people, what they do is that if a credit spread is losing, they will roll it out and they will change the positioning. So if they had an out the money call credit spread, they will roll it out for another out the money call credit spread. They might take in some credit, but the credit will be really ridiculous in comparison to the potential loss. So in the initial out the money credit spread that you entered, you may have been at a one win for a 10 for an 8 or 9 loss, right? And you rolled it out again and now again the most that you can make is maybe $2 and you're still exposed to an $8 loss. So $2 would mean $200 return for an $800 potential loss. So now you're potentially compounding really massive losses because of the fact that you are positioning your credit spread out the money. And that's not how I like to manage trades. What I like to do is if a call credit spread or a put credit spread is now in the money because the price has gone all the way through you, if it's the call to the upside, if it's the put, then to the downside, when you roll that out, you get a massive credit, sometimes 60, 70, 80% of the width of the spread. And so by doing that, you have the opportunity to make back whatever your loss was the day before, but you also have the potential to make a lot more money. And so on this day, when we rolled it out, it cost us $400 to make the roll. So if we would have left the trade as it was, we would have taken a $1,200 loss. So we said, no, we're going to pay $400 to roll it out another day and give ourselves an opportunity to be able to reevaluate this trade and see if there's a way to manage it. Now, the price came down, popped up, which was a little bit stressful because now we were here looking at a $200 loss. But then when the price rolled over and came all the way down, the actual return of this trade was $1,800 if you kept it until the end of the day. That is not what I advised people. I told people that I expect the price to come back down into this box. It would be inside our spread, which would allow us to minimize the loss that we had from the day before, but we weren't in the business of trying to make back all of the money. Now, just because of the way price action works, it did look like there was a high conviction that we were going to come all the way back down. And that's exactly what happened. We did push all the way back down. And so had you taken my note and seen that, okay, in this fractal, there continues to be strong weakness, you could have remained in the trade longer. But based on support and resistance from the day before, this is kind of the target area that we had. So different people manage the trade differently, but all in all, people should have been able to make back some of their loss from the Tuesday. And the blessing of that is that on Wednesday, Monday, we had a very nice win. And then Wednesday, Thursday, Friday on our systematics, we also had really positive wins. And on the Tuesday, we did have another hedge, which did return us some capital. So all in all, the trades for the duration of the week worked out very well. And our trade management also worked really well. I'm not sure if you guys have any other questions for those who are watching this and feel like I didn't cover a trade that we took or have questions about how a trade worked out. But feel free to, um, yeah, feel free to ask inside Market Talk. For those who aren't in the Discord or you like getting these videos to explain how we set up trades, what we're looking for, what our charts look like, then please feel free to subscribe to our new YouTube channel and you will be able to get the clips from our weekly roundup. All right, friends, bye for now.